Okay, students, we're back. Now, we left off on this page. I just talked about the two parts of the allowance method. First, we record the estimate of bad debts in the period when sales occurred, and then at some later point, when an individual receivable proves uncollectible, we have to write that off, that specific customer balance, as uncollectible. So to adjust for bad debt expense, for estimated bad debts, we're going to debit bad debt expense, and we're going to credit the allowance for doubtful accounts. Now you may be wondering, why is it that we don't just credit accounts receivable? Well, there's several problems with that, but the biggest one, there's the entry right there, debit bad debt expense, credit the allowance for doubtful accounts. You can see that reduces assets through the increase in a contra asset, allowance for doubtful accounts, and then we reduce stockholders' equity through the increase of an expense, bad debt expense. Now, down here they talk about subsidiary accounts. Now, let's say we have $1 million in accounts receivable. If all of those accounts receivable aren't from the same company, in other words, if we only have one customer, then that would be fine. But even there, don't we want to know how much they actually owe us? But usually you have a lot of customers, and so that $1 million balance may be made up of individual balances from hundreds of customers, maybe even thousands of customers. And so what we want to do then is make sure we are maintaining an equality of the subsidiary accounts with what's called the control or controlling account. Now, the accounts receivable account is what's called a control account. Now, what that means is that there is a subsidiary ledger somewhere that has a list of account balances that adds up to the sum of that control account. So we have individual customers, and each of them has a subsidiary account in a subsidiary ledger, but their account in that subsidiary ledger shows how much they owe. And so the total of those equals the control account. So the control account just shows what is the sum total of all those individual amounts owed by the individual customers who have outstanding accounts receivable with us. So we want to make sure there's equality there. So when we debit bad debt expense, we set up an allowance. And then to get the balance that shows on the balance sheet, we take the accounts receivable account and subtract any credit balance in the allowance for doubtful accounts account. Okay? Now, again, remember the allowance for doubtful accounts is an estimate. We are estimating that usually based on history, what we have observed in the past. Okay? Then when an individual customer's account proves uncollectible, we have to remove that account. That's called a receivable write-off. So to remove that account, we're going to credit accounts receivable for that, the amount we're reducing that account by, usually the balance. And then we're going to debit the allowance account. Now notice we are debiting the allowance account, not bad debt expense. We debited bad debt expense back when we set up the allowance. So we are debiting the allowance, which is a contra asset. It carries a credit balance and reduces accounts receivable. So we reduce the allowance. We reduce accounts receivable by the same amount. And so, as I said in the last video, net accounts receivable does not change as a result of a write-off of an individual customer account. Now again, let's just pretend we have $100 in accounts receivable and $10 in the allowance for doubtful accounts. So our net accounts receivable are $100 minus the $10 allowance. It gives us a $90 net accounts receivable balance. That's what we call net realizable value. Okay, now let's say an individual customer proves uncollectible. And I'll just say this time they owe us $5. And so what do? Well, we debit the allowance for $5. We credit accounts receivable for $5. So before we wrote their account off, accounts receivable was $100. The allowance was $10. We had $90 in net accounts receivable. Then we reduce accounts receivable by $5. We reduce the allowance by $5. Debit the allowance for $5. Credit accounts receivable. And so now accounts receivable has a balance of $95. The allowance has a balance of $5, credit balance. So net accounts receivable are still $90. A lot of students really struggle with this concept. Figure it out. I mean, I don't know how to explain it any more than that, but it reduced the allowance account is a contra asset that is reducing accounts receivable. So if we reduce both accounts receivable and the allowance account by the same amount, net accounts receivable remains unchanged. Okay, now that's the allowance method. We're going to get more into how do we calculate those amounts. But here you see journal entries. There is the journal entry to write off an uncollectible accounts receivable. We debit the allowance, credit accounts receivable. There you see the analysis of it. We reduce accounts receivable, reducing assets, and we reduce the allowance for doubtful accounts, which is a contra asset, and that increases assets. Okay, now again, they explain it, they walk you through examples. Do as many examples, go through this as many times as you need to understand it. This is really important that you understand this and get it down. All right, now there are two basic methods of estimating bad debts. One method is the percentage of credit sales method. You see right here. It's on page 357 in your book. But the percentage of credit sales method is really simple. We just take the amount of credit sales during the period and multiply it times an estimate of what percentage of credit sales will prove uncollectible. So let's say we had $100,000 in sales, and let's just say we estimate in credit sales, $100,000 in credit sales, and we estimate that 1% of those will be uncollectible. So $100,000 times 1% gives you $1,000. So under the percentage of credit sales method, we would then just debit bad debt expense for $1,000, credit the allowance for doubtful accounts for $1,000. Now, this is often referred to as an income statement approach. And the reason is because the emphasis is on the income statement. We're looking at the credit sales and saying, okay, that revenue is going to show up on the income statement. What percent of that do we think is bad debt? Okay, 1%. So we're going to take that 1% and debit bad debt expense. So the emphasis is on making sure we get the right amount of expense recorded, and then the allowance account balance is just whatever it happens to be whenever we credit it for that $1,000. Remember, debit bad debt expense, credit the allowance for doubtful accounts. Um, again, it's very simple, but it lacks accuracy. You know, will percentage of credit sales always work out? No, not really. Now, a better method is the second one. It's called the aging of accounts receivable method. And basically, what we do with it is take our accounts receivable, look at the balances, and figure how old are those balances. Now, as balances get older, the probability of being collected goes down. And so we age our accounts receivable. So you see an example here where they've taken their accounts receivable and they've broken the balances down into these age categories. So out of $208,000 in accounts receivable, 120,000 of those are 0 to 30 days old. So they're current, basically. 45,000 are 31 to 60 days old. 37,000 is 61 to 90 days old, and 6,000 are more than 90 days old. So then for each age category, we have a percentage. So those that are current, we estimate 1% of those will be uncollectible. For those that are basically a month past due or into their second month, that are 31 to 60 days old, we estimate 10% of those will be uncollectible. So we multiply that balance times 10%. The 61 to 90 day category, we estimate 20% of those will be uncollectible. And the over 90 days old category, we estimate 40% of those will prove uncollectible. So we multiply that balance times 40%. Now we add all of these numbers together, and that gives us our estimated uncollectible amount. In other words, the balance we need in the allowance for doubtful accounts account. Now, this is often referred to as a balance sheet approach. The reason is we're figuring out what balance do we need in the allowance for doubtful accounts that shows up on the balance sheet. And so we get that amount. Now that's the first step in this process of aging accounts receivable method. So we need a balance of $15,500, a credit balance in the allowance account of $15,500. Then we have to look at our allowance account and see what kind of a balance it has. And so in their example right here, they come up and say the desired balance is $15,500 right here. And the allowance account has a balance already of $14,200. Now, that's from, see if I can find it. Well, sorry about this. Here we go. So there was our allowance account balance. We need a balance of $15,500. So how do we get there? Well, we need a credit of $1,300 as an adjustment to get the balance from where it is to where it needs to be. So that's our desired balance. That's our current balance. So we're going to make an adjustment, debit bad debt expense, credit the allowance for doubtful accounts for this $1,300. That $1,300 is a plug number. That's what we call it, which is what we plug in to get the balance where we need it. Now, this is the more accurate method because we're actually looking at accounts receivable, figuring out what do we need to get the balance that we really should have. Okay, now I'm going to stop there and we'll go over homework in the next video.